Hi, this is Shane with the Rational Trader. It is Monday the 17th, yes, of December, in the closing stretch here of the year, last full week of trading. My results for my result for the day was plus 120. Let's get this up over here. QPNL 120. So that was one trade in oil. Let's take a look at that real quick. Oh, there's a nice down move right there. So I caught this. I got long right here. This is at 749. And then it's, what, 27 ticks because I'm trailing by 15, so I made 12. How much of a stop do you need to survive that? Let's see. 5105. 85. More than 30 ticks. So, is that right? 05, 95, 85. No, more than 20 ticks, but less than 30, you'd survive that. So then if you were using a 30 tick trail, what would you have gotten? 06, 96, 86. Actually a worse result. All right, so yeah, the reason this is important is that I'm not used to trailing so tightly. But the data is very clear. I don't have that program over here yet, so I can't show you. But it is very clear that in oil you're much better off trailing that stop really tightly, and you're because it makes lots of these little moves where it then doesn't do this. Instead, it just chops around a bit or something. But there's enough that where it just takes off that it makes it worthwhile. So you're looking. That's what we're looking for. You're trying to scalp our way into a runner. In this case, this looks painful as a human as you're watching it, going ah. But then, if you're actually trailing by a larger amount, you end up making less, right? 06, 96, 86. Yeah. So it's actually a better result trailing it what I think is too tightly. I missed this nice down move. That's unfortunate. That's the one you really wanted. And here off the news as well. So there's a little bit of a theme here because something similar in gold. So 241 and 264, these are traditional short codes that I'm not, which would have caught that nice move there. They're not in my list of code of behaviors that I'm looking for. All right, and that's because what the analysis is showing, or rather, when I do the analysis, what I'm looking for is repeatability and consistency across a 6-month time period. So that I have 6 4-week buckets that I look at separately. Look at the behaviors and what trades are executing, and with a good ratio of number of trades to profit. And those are the only ones I'm trading. So those are the ones that are in the list here. There's a set of, about 10 or so, and then 8 for the short side. And this code is not in that short list. All right, so, which is painful because that looks pretty nice. The problem is that it has not been showing up enough for me to have it in my, so I don't actually know without going and checking. Well, if I'm taking this 241 trade, what is the overall result across 6 months? Is it positive or negative? Though this was a nice trade. I'd have to go check. And you kind of the same thing here. There's some codes here that say, hey, boy, that'd be a nice short. But it's the same issue. Is that I'm interested in the result across. I typically look at it at least 3 months. I'm interested in the result across 3 months, not just today. And to do that, I'm willing to give up profit in a day if it means I can lessen the number of max loss days. So I'm trying to reduce the amplitude of the swings, right? And so we've kind of seen that so far. We don't really have enough live data here yet. Trade activity log. We don't really have enough live data. This is just a little bit more than 3 weeks. It's not enough to draw conclusions from. But I only see a couple of 3 max loss days here, or three days here they're losing it all, and otherwise, it's fairly steady. And then when you get those breakout days, then you get paid, right? So we'll see if this continues or not. This is what I'm aiming for. And one of the things about watching it as a human is that you see that and then you go, I should be trading that. So then you'll stick that code in without going and doing the analysis. Is that something that shows up frequently enough to do, or is it a net loss across the larger time frame? Okay, because you don't know what's going to happen next. All right, so the same thing happened in gold too. So let's take a quick look there. In gold, you can see it here. There hasn't the last couple of days we've had some nice movement in gold. It had been a little quiet, but there's some nice action codes in here that say get long. None of which are in my list to do. All right, and so it's the same issue. You need to go look at my analysis and say, okay, well, these weren't showing up as things that were reliable enough over time to put into the list to trade against. That could change as I redo that analysis. Right? So I redo that every couple of weeks or so. I just redid the CL one, and I'm looking specifically for drift in the behavior of the market, and I didn't see any in oil. So I did it 2 weeks ago, and I did it this weekend. So there were no changes in the codes that I'm trading there. I do have 6E is also trading live, but there were no trades taken. Take a quick look at it. I don't recall if there was. You got one shot at it here, and this nice breakout, and then another shot at it here. So I like where we're looking. We're looking in the right spots, but not seeing the behavior, not seeing the order flow, price action combination that we need to actually get a trade off there. All right, and then I have the indexes up in simulation. I'm not trading them live. I won't be trading them live for a while. But I went through the same process of building the models and then doing the analysis and putting in those codes. So this is NQ, and there's what I did is I put in only the ones that seemed the absolute best. So 6 or 7 long and 5 short. And my issue with this market is that it's too volatile. Here's the daily chart, and this subgraph here is showing us the average daily range over the last 10 days. And if it's more than 100 points, which is this red line down here, then it's too volatile to trade. And we're way above it and have been since beginning of October. So that's why this market is so dangerous right now. So until that settles back down, I won't be trading it. But I do have it up, and I'll just be looking at it and see. The data shows fairly wild fluctuations, so lots of max loss days, though you could still be profitable across that 90 or 100-day time frame. Not as much as the other markets because of those wild the number of swings in the profit and loss. So today, minus 5 ticks. No, minus 5 points. So that's two trades, which should have been the max. So let's see. Oh, look at this. This is crazy. I'm still at noon here. This is why I'm not trading this. This is just too wild. Yeah, so there's a long trade there, which can't survive that that whippiness. I thought there was another similar one I saw in the morning. Gosh, we're still just at 8 o'clock here. Where'd it go? I recall another one that was similar in that it nicked me, but the market's so active. Oh, there it is right there. So get long right here, 10 tick stop out to the tick, and then you get a little bit. This pullback is so deep, you're not going to survive it no matter what you're using. But anyway, this is the kind of behavior we've been seeing in that market in general. And then the ES is -2, so that means 2 trades also. Let's take a quick look. I'm going to go faster this time. Good Lord. So definitely, this is just sort of reinforcing my belief that I should just stay away from this this market. It's so active. So again, I mean, the discussion to have here is about the nature of volatility and its relationship to randomness. So here's a long that needs a much bigger stop to survive that. It's got the direction right, but not with a 4 tick stop. What was the other one? There's a short that's not going to work out. But getting back to the, if we just use this drawing space down here, if this side, there's a spectrum here, okay, between randomness, completely random. So over here, it's random. Random. All right, roll of the dice. Now there's no expectation that you're going to be able to predict what's going to happen over on this side of our spectrum. Over here, it's totally deterministic, right? This is deterministic. All right. It's math. It's gravity, right? Math and gravity. So 2 + 2 is always equal to 4, period. Gravity it's always the same. All right, things fall at 32 feet per second squared. Always. Whoops, I didn't change that. All right, and so the question is, well, what are the markets? Are they deterministic or are they random? And what do you believe they are is equally important, because how you handle these two cases is completely different. Right? The way you play blackjack or craps in Las Vegas is different than the way you would approach something like chess. Okay, and the reality is that the markets are somewhere in between. Okay, so somewhere in the middle is the true nature of the market. All right, so the reason that it's not deterministic is because there's too many inputs. There's so many thousands of people trading simultaneously, turn it into a nonlinear system. What used to be called chaos theory or complexity theory, now called nonlinear and dynamic systems. All right, now somewhere in the middle is where the market is. All right, but it's not. There's not a single answer because it changes over time. Okay, and so in quieter markets, you're more over here, and you could look at the order flow and price action and make a decision that's still not deterministic, but has a higher level of probability than something that is completely random. All right, and we're kind of seeing that play out in real time here as we track daily results, since we've switched to more normal markets whose line here is more towards the deterministic side. Volatility shifts this way over to here. Okay, and the more volatile you get, the closer you are to just completely random. Okay, now it's not completely random, all right, but it's more random than normal. It's more. You're much further to the left on the spectrum, and as a result, it's harder to look at the patterns of data and predict off of them. So that by itself is one issue. The other is that the volatility increases the size of the swings, and because of that, you need a larger amount of risk than your average retail trader is capable of sustaining. All right. And so my take is I'm not willing to do it. Since I've got other markets I can trade, I'll just trade them and wait until this shifts back over to here. All right. Now I don't have a completely quantifiable way to figure out what that magenta line is, where it is. That's something to think about. But as it stands now, what I've been doing in the NASDAQ is watching the average range. I even considered, above the yellow line to be too volatile in the past. In fact, it's funny because if you go back in time, this is May of last year. If you got above 60, which is here, if you got above 60, we had special rules in how we were going to play that day, how we were going to trade that day, and lots of things in place to help you survive that volatility. And now it's been insanely high for so long that it's simply not worth trading. So, all right, a little interruption there as my system ran into space. So, just one last thing on the indexes, then I'm just not going to talk about them anymore until we'll just check in with them once a month or so until they settle down. And that is that I have them up and I'm running them. This is in simulation for members, and also just to kind of keep an eye on them. The big problem here is that you see these big moves and you get stars in your eyes and want to be part of that, and you chase it. You're chasing rainbows here, and it's really dangerous. More people lose money in these conditions than any other. More people blow out their accounts in these conditions than any other. So, having said, take that to heart. It's worth thinking about. All right, so that's it. So we're today plus 120. We'll see what tomorrow brings, and take care.